Hello, and welcome to the Consistent Profits Podcast, brought to you by Inside Out Trading and Brian McAvoy, where the focus is on consistency. Because when you have the consistent part down, profits become easy. Hello, everybody. This is Brian McAvoy with a new episode of the Consistent Profits Podcast, and welcome. I'm excited today to be interviewing Rob Carver. He's a writer and professional trader. Thanks so much for being on the podcast today.
Thank you, Brian. It's a real pleasure to be speaking to you today.
Yeah, glad to have you, man. Now, for those of you not already familiar with him, Rob is an independent systematic futures trader, writer, and research consultant. He's also currently a visiting lecturer at Queen Mary University of London and a research advisor to Stylus Digital, a hedge fund trading digital assets. Rob has authored several books, including Systematic Trading, Smart Portfolios, Leverage Trading, and Advanced Futures Trading Strategies. Until 2013, Robert worked for AHL, a large systematic hedge fund and part of the Mann Group. He was responsible for creation of AHL's fundamental global macro strategy, and then he also managed the fund's multi-billion-dollar fixed income portfolio. Prior to that, Robert worked as a research manager for CEPR, an economics think tank, and traded exotic derivatives for Barclays Investment Bank. He spent his early career in the Middle East. Rob also has a bachelor's degree in economics from the University of Manchester and a master's degree also in economics from Birkbeck College in the University of London. Again, thanks for being here and being game for the interview, Rob.
No problem.
Trading is a kind of an outlier occupation. It's not one of the normal things that people do and choose for what they want to do for their living. So I always have to ask, how did you wind up in trading?
So you've read my bio there briefly. So what it doesn't say is that basically I went to university when I was 18 to study computer science, and decided after about a year that wasn't for me. And then I worked for a few years, and then I wasn't still really sure what I wanted to do, but I got quite interested in markets and finance. So I did a degree in economics. And then towards the end of that degree, I was applying for jobs. And the first people to offer me a job was an investment bank as a trader, which was a bit of a surprise to me because I hadn't actually, written under my form, I hadn't put trading as one of the things I was interested in. And I was quite surprised when I got to the interview stage and the guys interviewing me were, head of this trading desk and head of this trading desk. I'd kind of expected, given my background and the fact that I'm a massive nerd, that I'd be, working in research or something, or economic research. But yeah, the only thing I can possibly think of is that when I applied to the bank, they did this psychometric test to work out your personality type. And presumably, although I like to think of myself as a nice guy, presumably the psychology test came back saying, "Oh, this guy's a sociopath. He should definitely be a trader." I'm not a huge believer in the sort of accuracy of those tests, because actually that wasn't something that I really enjoyed either. So I did that for a couple of years and decided I really didn't like trading. Did something else for a bit, and then what I worked out was I actually do enjoy trading, but I don't enjoy trading in what I would call a kind of manual discretionary fashion. So making trading decisions myself. What I actually really enjoy doing is designing trading systems that do the trading for me. And I was very fortunate to get a job doing that for AHL for many years. And then for the last 10 years I've been doing the same kind of thing, but with just my own money.
Oh, okay. Very cool. Well, so how did your academic studies, at the University of Manchester, how did that kind of shape your understanding of the financial markets and market strategies that you took into your job?
To be completely honest with you, I don't think. Learning stuff like macroeconomics, it's useful to have a kind of vocabulary. So, when I was working as an interest rate trader, so it's useful to have a vocabulary to understand what central banks are talking about when they talk about monetary policy and things like that. But I would be surprised if there are really many traders who are using kind of these economic models to make trading decisions. I certainly wasn't. The closest I can come to it was when I was designing trading systems for AHL. We designed a system which basically tried to model the policy response of central banks. In other words, to say, okay, what do central banks say that they do? Well, they look, broadly speaking, they look at inflation and they look at economic growth, unemployment, measures of how well the economy is doing. what we found interesting was that although at the time, take the Bank of England or the ECB explicitly said that they did not consider economic growth, they were purely focused on inflation, whereas the Fed had a broader mandate. We actually found, we looked at their response functions, that, well, they were lying or not telling the whole truth, because actually they were responding to levels of unemployment, inflation, which is what you'd expect. But we're doing that purely, of course, to try and predict the path of interest rates more accurately than the market, and therefore build a profitable trading strategy on that basis. But that's the closest I've got to using kind of economic theory, I would say. On the other hand, the kind of quantitative tools I learned doing economics, I use every single day. So that's been a massive help.
Okay. Yeah, and actually, you touched on one thing that's kind of a big deal for me in trading and really in when somebody's learning anything, and that is that you got the vocabulary. That is so huge. It blows me away how I'll talk to traders, and we'll be talking about things, and I'll say, well, okay, we're throwing the term trend back and forth. What does trend mean to you? And it's funny because I found I can ask 8 different traders, how do you define the term trend, or how do you define a trend when it begins and when it ends? And I'll get all kinds of different answers. Same thing with support and resistance. And that's just, the sloppiness of the use of the words within trading, or the lack of clarity about them. And a lot of times traders, I'll ask them, okay, so you're using the MACD. What does that tell you? What does MACD even stand for? And they're like, oh, I don't know. It's like, but you're using this in your trading. You don't even know what it is and what it's telling you. So
This reminds me of an old joke, actually, which is, if you ask 2 economists for an opinion, you'll get 3 back. And actually, if you ask me what trend means, I can give you about 17 different answers, because I actually use 7 different ways of modeling trends in my model. In fact, there was actually a specific issue with the, maybe not the word trend, the word momentum, because the momentum factor in kind of theoretical economics, and also as it's used in sort of equity neutral hedge funds, means relative momentum. Whereas to futures traders, CTA traders like myself, it means absolute momentum. It means the price of an asset ignoring everything else, not relative to something else. So that's a example of a kind of a jargon failure. The other thing I found actually in the last 10 years, I was working in a sort of purely institutional environment, and actually the kind of language used and the models used in that environment completely differ from what the average sort of trader in the retail space, we call them a technical analysis, would use. So, for example, you use support and resistance. 10 years ago, I didn't even know what they were. Although, I was managing a portfolio of billions of dollars without knowing what those things were, because that's a concept that wasn't used in the institutional space. I know what they mean, but I still don't use them, because I'm still using models that are more institutional in nature rather than retail in nature.
Yeah, cool. Interesting to know, because support and resistance, that's like almost everybody uses them in some form or another. That seems in the retail space. So, very cool. Now, one thing I wanted to ask you about, going back to your early career, that you actually have it noted in your bio that your career started in the Middle East. Why is that noteworthy?
Oh, it's not noteworthy. It's just my shorthand of way of saying, oh, I used to do stuff that wasn't finance. So yeah, when I dropped out of university, I said, so backstory, I was actually brought up in the Middle East, in Dubai to be precise. I moved there as a kid. And apart from this brief spell at university when I was 18, I actually lived there till I was 25. So I spent almost half my life there, living there. And the sort of gap between being thrown out of university, doing computer science, to going back into university to do economics. I was working in the Middle East in completely unrelated field, related to sort of obviously the oil industry, but also the shipping industry. So it's quite fun for me actually now when I'm trading commodities, to actually think about the times when I was literally standing on a ship, counting bales of cotton going into a ship or something, or doing a dry bulk survey on a crude carrier to measure how much crude had gone or out of it. And now I'm trading this stuff, so I'm one step removed. But I guess most futures traders probably haven't had the experience of dealing with a physical commodity, and I have. It has absolutely no bearing whatsoever on my trading, but it's it's quite cool, I guess.
Oh yeah. Well, being able to do that though, that gives you a different kind of sense of reality about it though. I mean, one thing I took note of when I very first started trading, I started in commodities. Um, it was one of the things I liked about them is at least they're a tangible thing. Stocks and stock prices, very abstract. Uh,
Why does that matter?
Say again.
Why does that matter?
Well, for me, I liked it because at least the way I looked at it is um, the price of those things because they're physical goods. There will be some basis in reality for supply and demand. A lot of other instruments like currency pairs, stocks, those things. It's purely abstract and it's what people think. And so those things. That's why stock can go to zero in a day with real estate and commodities, real tangible things. Like I said, at least there's some attachment to reality. So
I mean, yeah, I'm going to interrupt. I'm going to interrupt and disagree with you quite a bit, to be honest. I mean, I remember when crude oil futures went below zero like 3 years ago. So, not for briefly, but yeah,
right.
yeah. So I take quite an opposite view, I guess. So my kind of starting point, because I'm trading systematically and I want robust trading models, is that unless I have strong evidence otherwise, I treat everything the same. So I treat S&P the same way as gold, as the same way as bonds, the same way as corn, the same way as butter, and so on and so on.
Sure.
And actually, the kind of identification of the asset I find unhelpful. So understanding or having thoughts about how an asset trade I actually find unhelpful. So I have to really stop myself from kind of doing something different, say in the fixed income space, because that's my kind of financial background. It's because I thought in my head I know more about the fixed income space, but actually that's quite dangerous. What I really want to do is treat all of these things like exactly the same and just as they're just numbers basically. And my prior view, and that's how strong evidence is that the behavior of those numbers should be no different from the behavior of any of the other numbers. I sometimes think maybe I should just relabel all of my instruments just A, B, C, D, E, and so on and so forth. But that will lead to practical problems, and it obviously is quite useful to be able to say, okay, what's my position in instrument XYZ? Well, actually, it's easy to say what's my position in US 10 years. So,
Right.
but yeah, I guess this is a difference between how discretionary traders think and how systematic traders think. To me, as a systematic trader, your prior should always be to treat things in a very abstract way, because you don't need to understand the fundamentals to build a model. If you see.
Oh yeah, that was just I was just referring to my affinity for the marketplaces. That's all. But
Yeah,
yeah, and as far as what you're saying with how to trade, yeah, indeed, because we're talking markets. We're not talking the actual things themselves. So yeah, yeah, on that we agree. I think that was just that's a little biased mind that I've always had from preference. That's all. Well, so somewhere along the way, you decided to write a book. So what prompted you to write your first book?
yeah. So as I said, I left from the sort of institutional trading 10 years ago,
Mhm.
and I wasn't sure what I wanted to do. One thing I did want to do was build my own system from the ground up, sort of a full stack. Whereas before, I'd focused on a quite a small part of the system, which is basically the part of the system that says, given price, what is position.
Mhm.
Um, I'd never worked with the kind of nitty gritty of getting prices in, cleaning them, having price databases, and then actually connecting to trading APIs and all this kind of stuff and building execution algos. And as my background, way back was in computer science, and I'm still very much interested in programming, I thought that'd be a fun thing to do. So I set about doing that. And while I was doing that, I was contacted by a publisher who was like, "Well, you got any ideas for books?" And I thought, well, yeah, I could write about what I'm doing now. I could write about the process of designing a systematic trading system from the ground up.
Mhm.
And that's basically where the first book came from, which unimaginatively I called systematic trading. Um, but I was surprised that no one else had already taken that title, to be honest. So it was too good a one to turn down. So yeah, that's where it came from, and the same goes in my second book. I was looking at my sort of long only investments in ETFs and shares.
Mhm.
And that's something I had actually been doing for many years. But whilst I was working in the systematic space, actually quite ironically, my share in ETF investing was very unsystematic, and I had a very messed up portfolio with lots of names and no kind of real process behind it. So again, I sat down about thinking about what's a way to apply what I know about trading futures systematically to trading stocks and ETFs systematically on a long only basis. And again, that's where the second book came from. So it's all kind of grown out of things I've been doing and then trying to explain to people how I do things.
Huh. Very cool. Very cool. Now, as far as in your systematic trading book, um, how did you wind up settling on, and just in what you use? I mean, there are tons of different strategies for trading, as you know. I mean, literally dozens of just high level at the high level, there are different strategies. What strategies do you favor, or strategy areas, or thought processes do you favor, and how do you address them in your book?
Well, I think a lot of this is path dependent. So I came out of a fund AHL that was part of the CTA space, and therefore the bedrock of what we did was trading trend, trading momentum.
Okay.
And specifically at the time when I was there, I'm not pretty sure it's no longer true. The kind of kernel of our models was using exponentially weighted moving average crossovers
Okay.
to determine trend direction and strength at a given speed. So that was and also those models are really good. I mean, particularly and they work across lots of different asset classes, and they work across a range of different speeds. They're probably they're quite a. I mean, they're not as simple as some other rules out there, but they're probably one of the simpler rules that's actually any good, I would say. They do things like, for example, adjust for the level of volatility in markets automatically. So you don't need to have special calibration for different markets, because as I said, my priority is to use the same model in every single market if I can. So that was the first trading rule that was in there. And the other second trading rule, and this surprising thing perhaps about this book is it only has two trading rules in it, because I didn't want to say to people, here's a bunch of rules you can trade with, because actually I believe that's not the most important part of building a trading system. I believe it's all the other stuff around those rules. So I only included two rules, but I thought it would be one of the things I wanted to explain was how to combine rules of different styles. So the other rule I turned to is carry, which is kind of well known in FX trading, but you can apply it to any asset class. Academic work's been done showing that across all asset classes, carry plus momentum explains quite a big part of the return, sort of 70-80%.
Okay.
So with just those two trading rules, you can actually build a pretty decent trading system. So that's why I chose those two rules. Now, what I did in my last book, Advanced Futures Trading Strategies, was to say to people, well, okay, everyone wants more rules, so here's a whole bunch of rules as well. But that first book was not about so much about rules. The rules were just there to explain how the system worked around those rules.
Okay. Now, again, going back to jargon, for those not familiar with the term carry, how do you use that? What does it mean, and how do you use that?
So carry is basically the expected return if spot prices remain the same. The easiest example is probably something like, let's say, buying stock on margin. So if you buy some stock, let's say the stock's yielding, I don't know, 4%, but to borrow money to buy that stock, you've got to pay 2%. So the difference between those two rates is 2%. So that means if the spot price of the stock remains unchanged, you're going to earn 2%. So your carry on that stock is 2%. So that would give you a long carry signal. If, on the other hand, the dividend yield was lower than the funding rate, it would be a negative carry position. And you can apply this to FX, where it's the difference between the two currencies' interest rates. You can apply it to futures, where you can compare the spot and the futures price, or you could look at two different futures prices potentially. So there's different ways of calculating, but fundamentally it's the same thing. It's what's my expectation if spot prices don't change. And this would not, basically the way of thinking about this is the following. This is sort of if kind of there was no way of making money out of carry, then what would happen was the spot would move against you by exactly enough to offset this return you expect to get, basically. But that's not what happens. In fact, you end up, on average, earning that return over time. and actually even slightly more. So it's quite a nice strategy, and it complements momentum quite well because generally speaking, it's not always true, but generally speaking, it's a bit more like a value or a mean reversion strategy. Generally speaking, if prices go down, the carry you're likely to earn on something will go up. So let's think about our stocks again. If prices of stocks go down but dividends remain unchanged, then the dividend yield will increase. So, if the price halves, then instead of having a yield of 4%, you'll have a yield of 8%. And the carry will go from being 2% to being 6%. So it becomes a much more attractive asset. So generally speaking, carry is a bit more like a value mean reversion strategy. So it tends to be quite low correlated to momentum. So it makes a nice package putting them together.
Huh. Very cool. Excellent. So you said in your first book you look at those two, but in your last book, the Advanced Futures Trading Strategies, you have a bunch more in there. What are some of the others, and why did you include them? Or just like one or two? What are one or two of the others, and why did you include them?
So a big theme of what I do is I don't believe that I have what I would call alpha, which basically means I don't believe I have an edge, really. So which people may find surprising. So what the reason I think I make money as a trader is because what I'm doing is collecting what academics would call risk premia. So basically, I'm taking on risks that the market is unhappy taking on, and therefore the market is willing to pay me for taking on those risks. So the kind of most well-known risk premia is the risk of owning stocks. So stocks are risky. People don't like that risk. Therefore, on average, owning stocks earns money because you're being paid a risk premium for owning stocks. But I believe there's also a momentum risk premium and a carry risk premium. Therefore, I expect to earn returns from holding assets with exposure to those factors. So what I try and do in my trading strategies is have as many different of these premium as possible. So to take another example, is there's something called the skew premium. So skew is the asymmetry of the return distribution. So if you think about something like stocks tend to be negative skewed. In other words, really bad days are more common than really good days. So if you look at the S&P 500 over the last 100 years, the number of times there's been a fall of more than, say, 5% in one day is probably about 4 times more than the number of times there's been a rise of more than 5% in one day. So those extremes are much more likely on the left tail. So people don't like negative skew. People don't like owning negative skew assets. They like owning positive skew assets. And the most extreme example of a positive skew asset is a lottery ticket, because it's an asset where your downside is very, very small, but your upside is extremely large, but obviously very unlikely.
Right.
People love lottery tickets. We know they love lottery tickets because they're willing to buy them, even though their expected value is roughly 50 cents on the dollar. So, you buy all the lottery tickets in the draw, on average, you'll earn 50 cents on the dollar. So we can make money from this by saying, well, skew's a risk premium. So therefore, if we own negative skew assets or assets that are more negative skew than they are normally, then we'll earn extra money. So what we can do is something like look at the skew of returns over the last, say, 6 months. And the more negative that is, the longer we'll want to be in that asset. And what that will mean is you will tend to be long assets like, say, stocks, which go up over time. You'll tend to be short assets that have very strong safe haven characteristics, like, for example, VIX futures, which are basically a bet that volatility is going to rise, and therefore, they tend to go down over time. But you'll also be long assets that have just recently had a horror show. So if something sells off drastically, then so if the stock market's just crashed, then you'll load up even more on stocks because stocks have become much more negatively skewed, basically. So that's an example of another one of these sort of risk premium type strategies that I like.
Huh. Yeah, very cool. Well, just the whole way you're viewing your trading in the markets, and I mean, even speaking in terms of risk premium and stuff like that. I've only heard that with a small percentage of people that I've talked to. So very cool you're taking that approach to it. Now, as far as so you've gotten your books. How are you generally? Well, do you have any other books that you still want to write or that you're working on?
Uh, yeah. So the only book we haven't mentioned is my third book, which is about trading with leverage, but sort of a bit more for kind of beginners, if you like.
Okay.
So I want to write a similar book, but for unleveraged trading. So that would be, again, stocks, ETFs, and whisper it crypto. Um, that would be the book I'm planning to write next, and then I want to write a book on backtesting, because there's that I think there's a big gap in the market for a good accessible book on backtesting. There are some very good books out there, but they tend to be quite advanced, and there are also some books that are written at the right level, but frankly aren't very good, and endorse some pretty appalling practices. So I think there's room for a good book about backtesting.
Well,
Um,
if you don't mind me interjecting, just because you mentioned it and you said bad practices, what do you see as bad practices with backtesting? Just because backtesting is one thing most people are aware of and they want to do it. What do you consider bad practices, just so they can avoid it if there's an issue?
I mean, overfitting is the obvious one. That's where you fit your trading model too closely to what's going to happen in the past.
Hmm.
And I think the problem is that well, there's two main problems. I think one is that people are using kind of off the shelf tools for backtesting without really understanding what's going on under the hood. And the second problem is that people are doing things while they're backtesting that they don't making them effectively overfit without realizing it. So an example would be testing a model, and then testing an alternative to that model, and then choosing the best one. That means you've basically done a form of in-sample fitting, and that because you've done that kind of outside of the actual process of, say, you're doing a rolling forward refitting process, you basically just you're going to lose a lot of statistical significance. So that that's the main one. Obviously, there's things around costs and leverage and so on and so forth, which I've talked about at length in my books before. But that's the obvious thing that people should stop doing, and it's actually quite a big hard topic to do. I mean, it's certainly big and hard enough to write another book about it. So yeah, probably that's my next two books, and then I think I want to write a book about bringing kind of some of the sort of things about quantitative finance, but trying to explain them in a very accessible way. So we talk about risk premium, for example.
Hmm.
I think every trader, or even every person, but perhaps if I'm going to be really greedy about potential buyers of this book, but I think every trader should kind of have a sort of intuitive understanding about risk premium, even if they don't understand, use it in their trading. And I think there's quite a few other key concepts like that around, for example, position sizing, where it's not necessarily about doing what I've done in my books, which is saying, well, here's the maths about how this works, but explaining more in more intuitive terms about why these concepts are important. So yeah, so I've still got a few ideas in me. I mean, I'm not 50 for a few months, so I've got plenty of mileage left. So
Yeah, not even you're still in your 40s. Yeah, you're a kid, man. Youngster in his field. Cool. Um, well, no, it's cool that you want to write a book on back testing. Yeah, I'm having a quality background. Yes, testing is a big deal, and yeah, I know that I agree. A lot of people, the way they're going about it, they're doing it in a manner that ultimately is not helpful, and they wonder why they're getting frustrating results when they go from back testing to live trading. And yeah, a lot of times, and it's funny because when I talk to people, they'll be like, "Oh yeah, yeah, back testing my system." And it's like, okay, so how did you go about it? And it's like, well, this is why you're frustrated, because you don't understand testing. I mean, for some people, it's like, oh yeah, sure, easy, yeah, I know how to test. It's like, no, you have to understand. Like when you mentioned one of my favorite words, the sampling is huge. It's huge. Your sampling screwed up, all your other testing can be a waste of time. So, yeah, very cool that you're going to do that. Now, as far as so you got these books coming up. Any other projects or things that you want to get out into the world?
um, yeah, I mean, not really. I mean, not really. So I mean, I do a few other things as well. I do a bit of teaching. I do some blogging. I have an open source sort of trading system that people can if used for testing and also implementing trading strategies. Although it's not it's what I use myself. It's my own system actually, so it's not kind of designed to be kind of very accessible. So it's not necessarily got a massive audience for it. But so yeah, I'm not really kind of intending to go down the path of, for example, you know, delivering courses or becoming a kind of YouTube trading guru. It's not really my personality, and also it sounds like quite a bit of work. So yeah, no, I'm happy to write a few books, gently sort of do research, publish it on my blog, do a bit of tweaking and updating to my trading system every now and then. But yeah, I left hedge fund management 10 years ago because I felt like it was way too much like hard work. So I'm certainly got no intention of working hard now. That's for sure. I'm very lucky to be in a position where I don't have to do that. I certainly couldn't be a manual trader. There's no way I could sit in front of the screen all day clicking. I'm afraid that's not for me. I can only trade as a fully automated trader. That's for sure.
Gotcha. Huh. Well, so as far as your books, you said you have four right now: systematic trading, smart portfolios, leverage trading, and advanced futures trading strategies. So if somebody's interested in starting in on your books, which would systematic trading be the best one for them to start with?
I would say no, actually. So I would probably recommend they start with leverage trading because that's written at a much more of an accessible level. And then so the book I plan to write would potentially go before that even. But then yeah, so I would start with that, and then maybe look at some of the others. Systematic trading is probably actually my most advanced book, I would say.
Oh,
One thing I found quite difficult is moving from a world where I'm sort of writing and explaining my ideas to people who have, going back to what we said earlier, very specific vocabulary and understanding of things at quite a high level, to explaining things to the average Joe on the street. It's not necessarily that straightforward. I mean, I can tell you a funny story. The very first chapter I submitted to my publisher, my very first book, I sent it to him, and he wrote back saying, "Yeah, Rob, this is really good, absolutely fantastic. The only problem is that I estimate that only 14 people in the whole world will understand this, which isn't a massive problem, but it does mean that every copy of your book will have to cost $100,000. And so, do you think you could make it a bit more accessible?" So I managed to make it accessible enough that a few thousand people have now bought that book. But I do feel like gradually through my career, I've been trying to make things more and more accessible and working my way to reaching a wider audience. So that's why my first book's actually the one you should probably read last right now, because it's less accessible than the others, because it's taken me a while to, we talk about some fairly complex ideas just in this half an hour, and or maybe not complex, but ideas that are unfamiliar to a lot of people. So it's quite a trick to explaining these ideas to people who haven't got that kind of background. And I feel like I'm gradually getting the hang of it, but maybe still some way to go.
oh, very cool. Well, now one question I have to ask, just because this is the Consistent Profits podcast. What do you see as probably one of the primary obstacles that most traders encounter regarding being able to produce consistent profits?
I mean, I have to say, and I risk being deleted from your listing here, but I have a real problem with this phrase "consistent profits."
Really?
Uh, what do you define as consistent profits?
Well, just being able to make money on a consistent basis, and
What do you mean by consistent basis?
for me personally, and what I try to get across to everybody is, uh, and this goes along with being able to treat your trading as a business, where you're doing it in like you like the systematic approach. Systematic, making anything systematic is so that it becomes predictable, at least to a degree.
So I think we agree on one thing, which is the importance of consistency. But for me, it's consistency of method, not of outcome, because the outcome, the profits are very hugely driven by luck, especially over relatively short periods of time.
Oh, agreed. Short periods of time, yes.
Yeah. So for example, I don't know what, if they say to me, "Rob, are you a consistent trader?" I'd say, "Well, what do you define as consistent?" And if you said to me, which you haven't, which is probably good, but some people might say, "Oh, do you make money every month?" I'd say, no. They'd say, "Well, do you make money every year?" I'm like, "No, I don't." do you make money every 5 years? I will be like, well, yeah, so far I have. I've got 2 5-year periods. I made money in both of them.
Okay.
So does that make me consistent? I don't know. It's still a statistically insignificant period of time, to be honest, to say. But if you ask me about my process is very consistent because it's purely systematic. So, it's in a sense perfectly consistent. But I do not. I'm a bit uncomfortable, I guess, with the idea of getting people to focus on profits, in other words, on outcome, because it is driven very much by luck, and I think it can lead to potentially unrealistic expectations, and those in turn can really lead to poor behavior in doing things like, for example, taking on too much leverage, overfitting trading systems, or trading too quickly in a sort of search to find the consistent profits that may not be achievable for, so I'm as a retail trader trading things with a holding period of a few weeks.
Mhm.
It's extremely unrealistic for me to expect to make consistent profits every single month. As a high frequency trader, institutional high frequency trader, I'd expect to make money pretty much every day. But that's not the reality for 99.9999% of traders out there, and it's the reality for 0% of retail traders, I'd say. So anyway.
Okay. Well, no, and I appreciate you being candid about it. Yeah, I mean, the fact that you hold a different perspective, that's cool. I mean, that's part of why I asked. So, but even actually, the funny thing is, even in within the context of your answer, we're still in agreement on a certain amount of things. Yeah, on the short term, can anybody say I'm going to make money in the markets today and do it knowingly and do it every day? No, pretty thin odds. But over a period of time, yeah, do you want to be able to say, yes, I have my process down consistent enough that yes, I can say with a certain degree of confidence, yes, I can expect these type of results reasonably. Because if you think about it, with any business, um, a lot of people say, well, trading is different because you have the uncertainty of the markets. Well, there's uncertainty in any business, and you never know what kind of factor might come along that just can totally wreck your business. I mean, even if you're like a restaurant, city comes along, they decide to do road work right out in front of your restaurant, and nobody can get in the parking lot for 2 months. That's going to screw you up. So anyway, no, that's cool.
Yeah,
Like
we can continue having this debate, but because I think the uncertainty is much greater in markets than it. But one thing I think is, in terms of thinking about as a business, I'm very, very focused on my costs of trading,
Mhm.
which are very predictable actually.
Mhm.
And I would know within a day or so if my costs of trading were, say, twice what they should be, and I
Mhm.
would be concerned about that. So I think that is an example of thinking about trading as a business that's a good thing. But I
Mhm.
think we disagree on the predictability on the revenue side, because for me it's the distribution of outcomes, even as a trader who's pretty good, is too wide to know really anything with certainty, except perhaps with multiple years, if not multiple decades of performance. But anyway.
Yeah. Yeah. Oh, no, fair enough. Sure. Yeah, we can agree to disagree. No problem. Very good. Well, yeah, this has been excellent. And everybody, if you like what Rob has to share today and his views and perspectives, definitely check out his books. I take it they're available on Amazon. Yes, or do you have another
I
preferred?
mean, they are, but I actually prefer if people go to my webpage, which is systematicmoney.org. And
Okay.
then if you click on the links to the books there, you'll be taken to the publisher's website. And as long as you're in a kind of reasonably major country, that should be price competitive with, and kind of, I get more money if you do that. So if you're feeling like, generally speaking, if you want to support authors, you should try and order direct from the publishers rather than from Amazon. Although, I have to admit, I do use Amazon myself, and it is very convenient. But one day all the bookshops will be gone, and we'll look at the smoking mess of, and say, what have we done? So I'd like to delay that day a bit longer if we can.
Yeah. Yeah. Good call. Yeah, worthwhile to bring up too. Well, again, Rob, thanks so much, and for everybody listening, applaud you for taking time out of your day to, learn and grow and develop as a trader, broaden your understanding, not just chasing strategies and the latest tips. So good that you're doing that, and we'll go ahead and wrap things up. And again, Robert, thanks for being here. Thank you for joining us today on the Consistent Profits Podcast, brought to you by Inside Out Trading. Make sure to swing by Inside Out Trading and pick up your copy of The Proven Formula for Consistent Monthly Profits. If you enjoyed the show, make sure to subscribe on your favorite channel, and we'll see you on the next episode. Cheers!